Welcome back to Insight, everyone. Right now, we're joined by Heather Foster with Foster Financial. Heather, it's always nice having you here today to get those money tips, right?
Yeah, and I mean, I think I try to break things down in a way that everyone can understand.
Yeah.
I mean, I can speak to the engineer and I can go complicated, or I can keep it simple. Today, I want to talk about a little bit the difference between brokered CDs and traditional CDs. So most people go, what? CD is a CD, right? Certificate of deposit is a certificate of deposit. And everyone right now is obviously a little bit concerned about banks and what's going on with the banking industry. So let's just talk about the differences real quick, because I have had this question asked of me a couple of times. Well, what if I just walk into my local bank and they're giving me a 4% CD for 9 months or 1 year? You know, what's really my benefit to buying a brokered CD through an advisor, especially if they're paying the advisor a fee? So I want to talk about the differences first of all. Number one, you'll notice right now that if you go to your local bank and you ask for a CD, they may be giving over 4%, 4.3, something like that in CD rates. But if you ask them for a longer term CD, so say you want to say, I don't want just 9 months, I want to lock this great rate in for 3 years, 2 years, 5 years, that's not being offered right now. The reason why is because interest rates are expected to stabilize at some point, probably in the next year, and actually go down. When they go down, the banks are going, hey, I don't want to give you a guarantee of over 4% for 3 years. I only want to give you that guarantee for 1 year because we expect the interest rates to fall. So all of a sudden, if you're in a higher interest rate CD, your CD is worth a lot. So that's good for the consumer, bad for the bank. So they're not making that exchange right now. In the brokered world, very different. In the broker channel, we can buy CDs that are considered on market, which means we actually can buy them on the market. We can actually sell them on the market. So again, when you buy a CD through your local bank, most people are very aware. I went into a 9-month CD, I need to hold it for 9 months. Because if I cash it out early, they're going to hit me potentially with a penalty. The penalty on a CD is normally they take some of the interest back. So most people go, I have to keep it for 9 months. With the brokered CD, because we're buying them on the open market and we're also able to sell them on the open market, you don't necessarily have to hold them to maturity. Now, let's go down the road again of the 9-month CD versus I say, hey, we love these rates. We like 4.5% and 5%. Let's go with the 3-year CD. But people go, I don't know if I could, I don't know, maybe I'll need the money in that 3-year period. Again, no one's even offering those kind of rates for 3 years if you walk into your brick and mortar bank. But on the broker channel, we can get 3- and 5-year CDs at these high rates and lock them in as a non-callable CD. But if, again, someone is concerned, what if I needed the money in the next 3 years? So here's the thing with broker CDs. Because we can sell them on the open market, we can say, okay, you need out of it, we can put it up for sale, and we can get bids for that CD. The beauty of it is, if the expectation is that interest rates are going to go down, but you bought yourself a 3-year or a 5-year certificate of deposit at, let's say, 5% interest rate, your CD now to sell on the open market in 3 years, if interest rates have fallen, and now you as a consumer can only go out and buy a 3% CD, but you've got one for sale that's paying 5%, we can now put that on the market at a premium. Now, not only do you have a higher interest rate than you can buy currently, but you can also sell this at a premium. So it actually becomes a lucrative move. We call these strategic. So if you're a broker or you're curious about brokered CDs, we use them as actually a strategic vehicle to say, hey, for now, maybe we don't want to own bonds or bond funds because they're going down. We want to own certificates of deposit, but we want something that we can maneuver around. If interest rates fall and our CD is now worth more because our interest rate is so much higher, we can negotiate, sell it at a premium, and buy back into the bond market. So there's a lot of fluidness to this. There's a lot of flexibility. If you can guarantee somebody, 5% on a certificate of deposit, I mean, we're seeing a lot of movement in this area. We can typically get higher rates in the brokered channels. Plus, we've got different flexibility with them.
Most definitely. A lot of those things breaking down, talking about the differences in brokered CDs and traditional banks. Take a look at your screen right now. You can find much more how to get in contact with Foster Financial. Look, be sure to get that consultation and learn more and get those questions answered. We'll be right back.